I would like to ask consumers, hey, those that are on the GLP-1 drugs, would you rather give up the GLP-1 or your subscription to ChatGPT? In the last 30 days, Lou, we have seen SpaceX unseat Oracle as the fourth largest hyperscaler. We had them sell a huge block of compute to Anthropic. We saw another huge block go to Google. Nvidia, their valuation right now is near its 10-year low in terms of forward earnings. The fear of missing out is not an investment strategy. And so the only way to recapture those losses isn't just to hold it forever. The only way you can recapture that is if interest rates go back to zero. And candidly, I just don't think that that's possible.
Welcome to The Big Skinny with Lou Basenese, where we serve up everything 111. One headline that you should think twice about because the consensus often gets it wrong. One chart you should absolutely pay attention to because the data seldom lies. And one investment insight you can use right away to hopefully increase your bottom line alongside ours. And today it is my pleasure to welcome Ted Thatcher, founder of Bright Lake Wealth Management. Welcome to the show.
Lou, it's great to be with you.
Great to have you here too. I know you've had a busy day, so hopefully this is the most enjoyable part. We can have an easy conversation.
I'm sitting down. I'm in a comfortable spot. It's going to be outstanding.
Yeah, you make me feel bad. You're all dressed up, so we go t-shirts in here sometimes.
Fine.
But listen, a lot of headlines going on this week, particularly about the first Fed meeting. One coming from us talking about the honeymoon being over between Kevin Warsh and President Trump, and that the stock market is going to be the ultimate loser no matter what happens. Do you agree with that, or you think the Fed has that much control over the stock market?
Look, I think the first rule in investing is oftentimes don't fight the Fed. You know, figure out what they're going to do and get out of their way. Although I personally do not believe that we're just going to see a bunch of red coming out of this Fed meeting. Obviously, no expected rate change. The probability, of course, is I think 99% that we're not going to see anything. Really, this week, to start it off, we've got a bunch of green. You know, I'm calling this the peace deal put is kind of how I've framed it, because, you know, oil's flying down. We see a little bit of consumer relief on the inflation side. I actually think it kind of sets things up nicely for Kevin Warsh's first meeting of him really being in the batter's box.
Is there anything you're looking for from the first Fed meeting under Warsh? Is it comments that might be different from Powell? Is it the dot plot? Because last time in March, there showed still expectations for easing. Are you worried about a pivot to maybe some hawkish tone? I mean, what are the things that concern you as you look at the market, your clients' portfolios, and what's happening?
You know, I think that Warsh's first and primary goal is actually going to be to win the credibility of the markets. And the reason is, you know, I think if he, you know, kind of bends to some of the political pressure that he faces for lowering rates, I ultimately believe it's going to be a punishment when it comes to the bond market. You know, the bond market really ultimately is the governor on how quickly they can get to the lowering. We've heard some, you know, stirrings, rumors about deflationary AI, you know, driving, you know, costs down. We're not living in that world yet.
Yeah, it hasn't happened yet at all. I don't see it in any of the data, but Warsh made some comments along those lines that he expects it in the longer term to be deflationary. You think he echoes those sentiments this week, or he stays away from that?
I think he would be wise to actually stay away from it. I think that because we've gotten the lower oil prices that we have, it kind of opens the Overton window to comments like that not being totally suicide. I don't, though, think that he should jump into that narrative yet with both feet. I think just being measured, you know, talking data heavy is really going to be what I think actually would calm the markets and actually calm, again, the bond market being a governor on everything.
Yeah, I completely agree. You touched on something that I think leads into a chart that's really important, is the consumer and oil prices coming down. That's been a pain point pushing into other, you know, categories. Consumer real wages have now flipped negative for, I think, 2 or 3 months in a row right now. How do you see the state of the consumer? Is it something to be worried about? Are we looking at maybe rolling over into a recession if this price pressure keeps up and this, you know, real wage growth remains negative?
You know, putting, you know, the consumer front and center, I think, is so important whenever you talk about the economy, because there's really always, it seems like, two economies going on these days. There's the, you know, financial economy on Wall Street, and then there's the consumer on Main Street. And there's no question the consumer's been under a lot of pressure. Now, the real reason I think that number has flipped is just because we've had such a significant spike on the inflation side. And it's the supply shock, you know, coming because the Strait of Hormuz has been closed. Now we have, again, some light at the end of that tunnel finally.
Hopefully.
Yeah, hopefully. We'll see. I mean, it's not the first time we've been promised peace and, you know, gotten something that looked a lot less like peace than we thought. But ultimately, you know, to kind of quote our friend Scott, you know, there's this their bowling ball that's moving its way through the boa constrictor of the economy with these elevated inflation rates. And so if it ends up being the case, and I think, at least 80% of the inflation we've seen is probably just due to the price of oil being higher, that should mean ultimately that flips back and consumers aren't under ultimately as much pressure
so
as
it should ultimately be transitory, unlike what Powell thought. This is the right use of the word transitory. Right. You don't want to use it's different this time and transitory. It's negative words associated with that. Let's talk about opportunity, right? We're talking about the forces that could be pressures on the market, but tons of opportunity out there. One of your favorite picks out there that you own with clients' accounts is Eli Lilly, which I've been on the record saying that it would be the first $1 trillion big pharma. Then it's going to be the first $2 trillion. What do you think? What's your bullish take on it, Eli Lilly?
Eli Lilly sits, I think, in a really unique part of the discussion in the marketplace right now. I mean, it seems like every headline has something to do with the AI economy or how much is, being spent on CapEx to build out data centers. Yeah. I like to ask the question, to come back to the consumer, what is driving the most value for consumers right now? And I think a really interesting discussion to have is you've seen, these GLP-1 drugs just go absolutely bonkers across the United States of America. There's millions and millions of Americans taking these now. And to great benefit, it seems. Look, I'm not a doctor, but beyond the weight loss, we're seeing all kinds of anti-inflammatory benefits. You're seeing reports about some type of cancer risk going down, all kinds of different things. Again, I won't speak as a physician on the topic, but there's so many benefits that we are seeing. I would like to ask consumers, hey, those that are on the GLP-1 drugs, would you rather give up the GLP-1 or your subscription to ChatGPT?
Because I think vanity or intelligence, what are we choosing,
something like that. But I mean, just to have the discussion about where are consumers receiving value, I think it's a really interesting one, and why I'm really so bullish on Eli Lilly.
You talk about, too, the pipeline there, right? Because everyone thinks of Eli Lilly and Novo Nordisk, which is its counterpart that's super undervalued, but really struggling in terms of keeping up with the science side and the effectiveness. But you talk about its pipeline and the building out of new assets and other indications. How do you factor that into your bullishness?
Well, I think anytime you're innovating and wanting to stay on the front edge means that they will continue to have the market share and potentially expand that market share. Yeah. So we're not stopping at GLP-1s, it's GLP-2s and 3s at this point. Yeah. And, again, they have the distribution, which is a hugely important part of this. And so, obviously these FDA trials take time, they're tedious. There's a lot that goes into the management of them, honestly. And so I think because they're further along, on the train, as it were, they're in a great position.
Yeah, no, I couldn't agree with you more on this. In fact, I did a study trying to find out how many indications GLP-1s or 2s or 3s are showing efficacy or some indication of. It's at 38 and counting. So I think these are going to be very much miracle drugs, which sounds a little snake oil salesman-esque. But so how do you think about exiting big positions like this, right? As these companies grow and mature, because I know you've had clients in Mag 7 names. If Eli Lilly doubles in size, how do you manage that from a risk management side?
I mean, obviously we're bullish on Lilly, but it's had a huge run up. So whether it's Eli Lilly, a Mag 7 name, SpaceX, these high valuations, investors start to ask the question of, well, how should I get out or how should I even get in? Someone might listen to this and say, oh, that's a great name. I like the thesis. What should I do here? Ultimately, I think the most important thing to say, and a really important reminder for investors, is that the fear of missing out is not an investment strategy. FOMO is not an investment strategy. Man. Yeah. If we're going to be going into the growth part of our portfolio and say let's say we invest $1,000, let's be systematic with that $1,000. Let's use a 30%, 40%, 30 rule. Let's start with 300, and pick some time frame, maybe whether it's 3 months, 6 months, or a year. Do 30%, halfway through do 40, and then at the tail end of that do another 30. I think you can do the same type of thing on an exit strategy. But what's most important, again, is that we're not just buying because we think it's a great idea, but we are being systematic with our investment strategy.
Yeah. No, well said. Good portfolio management advice too. If you haven't noticed, we're all about all filling, zero fluff, and so is our email newsletter where we deliver insights, one headline that you should probably ignore, one chart you should absolutely pay attention to, and one investment idea that you should follow to increase your bottom line right alongside ours. So if you're not signed up yet, go to thebigskinny.com, sign up for our newsletter. If you can't be bothered to give up your email address, that's okay. Give us a follow on Twitter or on YouTube so you never miss another episode. Before you run, I like to hit some quick hitting topics. So like you brought it up, SpaceX. What are your thoughts on SpaceX? Bullish, bearish? How do you get in, play this, IPO pop if you didn't, get an allocation or enough of an allocation?
Yeah, well, I mean, certainly see above, how we come at buying into a position like SpaceX. But honestly, I think that there are so many market commentators that take the bear case against SpaceX. They say, okay, let's look at, the trailing 12-month earnings. We're at 300 times for the valuation of $2 trillion. Today, it popped another 20%, 19%, $2.5 trillion valuation. Is there a fundamental case to be made? Look, I think it's unreasonable to say that this is not a high valuation. Yeah. But I actually do believe that the bankers weren't being totally blind when they priced this IPO. They were basically giving Elon and the management team at SpaceX credit for 2 years of excellent execution. Yeah. They expect SpaceX to have $160 billion in revenue in 2028. They expect them to have $110 billion of EBITDA. They don't actually have to hit that number for a $2 trillion valuation to start to make fundamental sense. And I'll explain why. So if we just set aside the launch business, which absolutely is a monopoly, it's a huge moat, and really it's the toll booth to orbit.
Even more so now because of Jeff Bezos' unfortunate explosion, right?
That's exactly right. Yeah. And we could set aside, Starship and getting that to reusability and then, rapid reusability. We can also set aside, their Cursor acquisition and the amazing ability coding, agents have in that space. Those are basically call options on the company. We can go straight to Starlink as a connectivity business and say that revenue is high margin and it's absolutely growing exponentially. And fundamentally, and I think this is maybe underreported, but it's going to be talked about a lot, is just how incredible Elon and company is at standing up compute and selling it off. Colossus 1 took 122 days for them to build. That is light speed. Yeah. And speed matters because every day is cost. Colossus 2 took, I believe it was 92 days to stand up. In the last 30 days, Lou, we have seen SpaceX unseat Oracle as the 4th largest hyperscaler. We had them sell a huge block of compute to Anthropic. We saw another huge block go to Google. Yeah. That, of course, adds $26 billion of revenue to their, income statement.
I think, and correct me if I'm wrong, I think the Google contract, if you added that to their annual run rate, brought the price to sales from 90 down to like 52 times. So like one single deal immediately changed the valuation math.
Absolutely. And that was right going into the IPO week, right? So that's a really positive. But what I think is most interesting to me about those numbers, outside of just the sheer fact that they're impressive, is if you look at the other neoscalers, they expect to earn $15 to $20 billion per gigawatt per year on their compute. Yeah. The deals that SpaceX now has with Anthropic and Google are basically priced at $50 billion per gigawatt per year in the case of Anthropic, and actually 50 to 70 in the case of Google. So not only are they doing it faster for less money, they're getting about 4 to 5 times the margin on that revenue. And that's in the last 30 days. Yeah. Let's just see what they do in a year.
All right, let's see. Do you think in the next year they acquire Tesla?
Ooh. This is a tough question. Part of
There's no wrong answers here.
Part of me would be really excited if they did, because I just think it brings in, the full stack of Elon's companies. They probably have to, I think they would have to change the ticker symbol to Elon or something like that if they did it.
It's actually a great idea.
Yeah. But, I don't have a hard and fast rule on this. I think if at some point, if it makes sense company-wise, that would, likely be rolled in. Also, if they do that, I just think that SpaceX current CEO is just magnificent. She's done a fantastic job and clearly extremely competent.
Yeah, great interviews with her too about how her and Elon divide the roles and responsibilities. Let's move on to other mega cap names, right? Because I think most people are losing sight of the fact that Mag 7 stocks have come down in valuations because they keep growing earnings at such an impressive clip. Last quarter it was north of 60% earnings growth, blended for the Mag 7, which had been in the mid 20s for 4 quarters in a row. Are there any Mag 7 names that you really think are attractive at these levels, or ones that you think people should be avoiding?
Yeah, I mean, obviously, you see a run up and a rally in the markets and you start to think, is everything overvalued? I don't believe that's necessarily the case. You just got to, know where to look. This has been cited a lot, but Nvidia, their valuation right now is near its 10-year low in terms of forward earnings. We're talking about a company that's trading around 20-ish times forward earnings. Their 10-year low is 18. As the largest, company in the world, they're kind of at the mercy of their size this. And also they're at the mercy of all the hedge funds who are just, selling against them just for the risk mitigation. But as they get re-rated as a company, I do think that they just have a ton of upside. And I know Jensen's pounding the sand and, pounding the pavement, for that. Another one that does stick out to me is Microsoft. I think Microsoft's gotten really punished, sadly, for the diversification of their business verticals. And of course, they kind of got caught up in the SaaS apocalypse. Investors being concerned with their per seat pricing throughout the enterprise.
Do you think they can resolve that with a new model as like a per agent license? I know that they floated that idea into the market and hasn't taken, but
I think that it will come in practice because they got a lot of flack, I think kind of rightly actually, for the Copilot release. I think it was a little bit premature, candidly. I don't know if anybody's tried to use Copilot on Microsoft Word, but it's kind of a mess. But coming out of, I think it's called Build, their big keynote event, they are moving more agentic. And the truth is distribution, and case in point, Google, distribution is so important in the game of business. Yeah. And they are absolutely built on all the enterprise rails that exist across Fortune 1000 companies. And so I actually believe over time, we will see Microsoft get the benefit of that distribution and not be sort of punished for it, actually. Yeah. And so again, at 24 times trailing earnings, at 21 times forward earnings, I think it's a solid value. It's also trading at, it's really close to its 200-week moving average. And I've cited this quote a lot, but Charlie Munger always said, if all you did was buy great companies on the 200-week moving average, you'd vastly outperform the S&P 500.
Great companies at great prices make great investments.
Exactly.
So you talk about, I think Microsoft too, I personally own it as well. Mm-hmm. I started buying because it's, I think, trading at its lowest valuation relative to the S&P 500 in the last decade. Yeah. So very undervalued. But you talk about them having the rails and the distribution similar to Alphabet and Google. What about Apple? How do you fit this into their play, right? Heavily underinvested in AI, but now they have 2.5 billion devices in the wild, and they're saying, we can be AI model agnostic and just be the distribution pipeline. Do you think that benefits them, or is it still a risk?
Look, I think in a lot of ways, building out AI compute, the sort of existential risk in some ways is under building. But for Apple, their moat, to go back to SpaceX, the moat that SpaceX has in launch, Apple has in hardware.
Yeah.
And so I do absolutely think, funny enough, at their most recent earnings report, what did they say? They said, hey, our business is benefiting this. Everyone that wants to run their own local models is buying Mac Minis and studios, and that's only going to continue to increase. And interestingly, just very topically, Satya Nadella wrote that sort of, personal op-ed article just about how he sees AI operating in the future. I think fundamentally, businesses are going to have to keep their own proprietary information, their own IP, and really benefit from that, which if you apply that on the consumer level, ultimately means that it kind of calls into question actually which frontier model makes most sense and how they're going to fit in the value stack. But personal device running AI for you becomes, I think, really valuable.
Yeah, no, I agree. Well said. What other IPO are you looking forward to? We got OpenAI, Anthropic in the pipeline, some other names rumored to be, confidentially filing soon.
Right. I think that obviously the Anthropic is the next one on deck with OpenAI right behind it. I have to say, just recently I've been very impressed with Sarah Friar, their OpenAI CFO. But when you look at Anthropic's revenue growth, obviously they've got caught up in a lot of headlines this last week with Fable 5 being released and then having to be taken down, and whether it's digital weapon and all these types of things.
Didn't they ask for it though? Because he did talk about, and he wrote an essay a week before saying like, hey, we should probably hit pause, and you're not going to do it on your own. We're going to do it for you.
It wasn't just it's been months and years of this. It feels like they're basically almost playing the game for regulatory capture here.
Yeah, totally.
So I think that they kind of painted the target on their own back for sure. Totally agree. But because of their revenue, I think it's just such an exciting potential IPO. And so, certainly I think all eyes are going to be on that next.
Yeah. Anything else in the market? I always love to ask this question that you see from your vantage point of years in the market that you don't think people are paying enough attention to. It could be a risk, an opportunity, a sector, just a way of managing portfolios. Is there something that really you're paying attention to that you don't think anyone else has figured out?
One thing that I'll say even a lot of financial advisors might disagree with me on is just how important it is to not set it and forget your investment strategy. There's so much to be made of indexed investing and just completely setting it and forgetting it. But when it comes to real planning and being thoughtful about holdings, I think that there is a place for, strategic moves. Obviously, we've talked about examples of undervalued companies today, but maybe the one I think I've seen affect most investors in the last 5 years negatively is these buy and hold risk mitigation strategies where people just hold on to the bonds they own forever.
Yeah.
I can't even tell you, I can't count on two hands. I would probably be in the hundreds, perhaps, of how many portfolios I watched over 2022 and 2023 that we went through that rate hiking cycle on, where everyone was just setting it and forgetting it. They had long-term assets.
Didn't trim duration at all.
Didn't do anything and just got hosed.
Yeah.
And so the only way to recapture those losses isn't just to hold it forever. The only way you can recapture that is if interest rates go back to zero.
Yeah.
And candidly, I just don't think that's possible.
So talking about your wealth management practice, how you differentiate yourself as an RIA and where people can find you to work with you?
Yeah. So our RIA is Bright Lake Wealth Management. We really do focus on retirement strategies and planning, focusing on investment management, tax strategies for your investments, and certainly the estate planning side as well. So that trifecta is really where we fit in. Certainly you can go to brightlakewealth.com. Also, you can find me online, just Ted Thatcher on Twitter or Instagram or
all right.
LinkedIn.
Most important question. After a long day, what's your next move? Martini, slice of pizza, watching Knicks championship highlights? I don't know. You might be a Lakers fan.
No. I was absolutely cheering for the Knicks. Knicks in 5, man. Part of me wanted them to go to 6 just so I could, try to make it down there. Yeah. But my next move, man, I'm gonna, take a honestly, hopefully get a glass of water and then, maybe a piece of pizza and a martini.
Awesome, man.
I like that.
It was a pleasure having you here. Appreciate your insights. Look forward to having you back.
Likewise. Thanks.